All right, good morning everyone, and welcome to today's webinar, Tax Updates, What You Need to Know in This Ever-Changing Landscape. My name is Stanton Anker. I'm part of the South Dakota Bar CLE Committee. Before we get started, I'd like to go over a few items so we all know how to participate in today's event. We've taken a screenshot of an example of the attendee interface. I don't know if you can see that at this point.
I don't think so.
Okay. Well, the panel on your on the right side of your screen, if you want to submit any questions at any time during today's presentation, please type those in and we will address those questions. There will be times between each part that's being covered today for the presenters to answer your questions, so just please send those to us. If you can't get those to work through there, you can always send them by email to us as well. I'd like to introduce our presenters for today. We've got Joni Steinmetz, Lori Larson, Elise Foltz, and Kimberly Robinson, all from Casey Peterson here in Rapid City. Jenny is the Tax Services Manager at Casey Peterson and has been with the firm since 2018. Jenny has over a decade of experience in public and private accounting and specializes in identifying opportunities for efficiencies for organizations. She graduated from Colorado State University with a Bachelor of Science in Accounting and is licensed in Colorado and South Dakota. She is also the incoming treasurer for Wavy here in Rapid City and a graduate of Leadership Rapid City class of 2019. Lori Larson has over 18 years of experience in public accounting and specializes in assisting clients with trust and estate strategies. Lori is a tax manager and has been with Casey Peterson since 2006. She received her Bachelor of Science in Professional Accountancy from Black Hills State University and is the treasurer for the West River Estate Planning Council. Elise Foltz is a senior tax associate with Casey Peterson. With over 6 years of experience in public accounting, she's focused on supporting tourism and hospitality. Elise works closely with her clients to understand their unique needs to be just a phone call away. Elise has a Bachelor of Science in Professional Accountancy from Black Hills State University and is an investment advisor representative. Kimberly Robinson is a tax associate and interim accounting services manager with Casey Peterson since 2017. Kim assists clients with IRS representation as an enrolled agent. Kim received her Master's of Business Administration and Accounting from Colorado Technical University. And now I will turn this over to our presenters today.
Good morning, everyone. This is Lori Larson. I'm going to be presenting on the trust and estate portion this morning. I thank you all for joining us. Today's agenda is just going to be up on the screen here. We're each going to take a part. After each of us has said our portion, you're more than welcome to ask questions, and Stanton will be reading those for us. So what I wanted to talk about today is a couple of items that I've seen going on in our profession lately, and maybe how lawyers and accountants can work together to service our clients a little bit better. So to start off, I kind of wanted to talk about filling out the form SS4 and discussing what year end, why we choose what we choose. So to start, typically trusts must choose a calendar year end unless it's a living trust or revocable trust and elects to be to be taxed as an estate. You can only do this if the estate is to be closed in a year or less, meaning we only have to file one tax return. Otherwise, we have to elect for a trust to have a December year end. Estates can have the option to choose a fiscal or a calendar year end. The reasons behind choosing a calendar year end for an estate, There's usually multiple 1099 forms to record interest, dividends, stock proceeds, etc. And those forms are reported to the IRS on a calendar year-end basis. So the cutoff is super clean for reporting purposes if we choose a December year-end. Otherwise, we have to report all of the income on the 1041 using the dates on the statements, or we have to use an allocation of income method based on the days if the statement doesn't break those out and we choose a fiscal year end. Also, if you have a short year and you want to be finished and all the estate be dispersed by the end of the year, so the beneficiaries only receive one K1, the clean cutoff would have a December result. If the decedent passed away in January, the fiscal and calendar year end will be the same as December, and we'll talk about that in just a second. So I have a couple examples on the PowerPoint slide reporting if the date of death was February 15th of 2019, the estate will run from February 16th, the day after the person passed away, through January 31st of 2020. And that return would be due May 15th of 2020. However, if the date of death is on the last day of the month, so in this case, July 31st, the estate runs from August 1st to July 31st. They basically get almost a full year's worth of reporting, and that estate return will be due November 15th. The IRS changed the extension due date a couple of years ago. We used to have a 5-month extension period. It is now 5.5 months. So if you have a trust that files on a calendar year end, normally December then, that return is usually due April 15th. If you file an extension, that now is not due until September 30th. On the screen now is the SS4 form that I'm sure most of you are aware of and fill out on a periodic basis. We typically in our office try to fill out this form online. There are several ways you can do it. You can do www.irs.gov, type in the SS4, and it'll allow you to go through a series of questions to be able to get the EIN number online. Otherwise, you can fill out and either fax or mail in this form. Our office normally does the online fill out because you can instantaneously get the EIN number, and also because the paper form asks for a lot of information that's not necessary for you to be able to fill out when you're trying to obtain the EIN number for a trust or an estate. Specifically on line 11, it says the date the business started. This should be filled out with either the date the trust was funded or the date the trust was required to obtain an EIN number. And if it's for an estate, this should be the date of the death of the decedent or the date the estate was legally funded. We have gotten a lot of communication from the IRS regarding this and the next issue, which I'll mention really quickly, the closing month of the accounting year. That is line number 12, I believe, yes. And this should not, you shouldn't automatically put in there December. And that's because of the discussion we had 2 minutes ago regarding the fiscal year end. In the case of a calendar year end, then December is the correct month to put in there. However, if it's a fiscal year end, the month end that they would like to see in that box is the last month of the fiscal period. So for example, if the date of death was February 15th, the fiscal year would run from February 16th to January 31st. In this case, the last month of the fiscal period is January. Hence, the closing month of the accounting year, you should put in January. Be careful when you, with that. So what we see is when the SS4 form has been filled out, people are putting in the incorrect either creation date or the closing month, and the IRS issues an actual transcript of the SS4 form to both the client and the person that applied for the EIN number. The issue is if you choose December, it's going to say that they have a tax return due April 15th, which not necessarily is the case in a lot of circumstances. So just to be aware that we see that quite a bit. Also, we've gotten a lot of correspondence about people checking the box on number 13 that they will have no employees in the coming months, but they actually do. It causes confusion in the IRS's eyes with what forms need to be filed and also if they do or do not have employees. So be careful when filling out that box as well. Just a couple of points I wanted to touch on with that SS4 form. Next, let's talk about the taxation of trusts. I think this gets a little confused and jumbled when both our clients and in our minds sometimes. So I just wanted to kind of simplify what these all mean. So if you have an irrevocable simple trust and the trust has more than $600 of income from any source, it can be earned or unearned income, they have to file a tax return. By indication in the trust agreement, income must be distributed to the beneficiaries and reported on Form K-1. So they have to pass the income out to the beneficiaries. It is based on a pro rata share of their distribution in relation to distributable net income, which is a calculation that nets on the tax return. So for example, if you have 3 beneficiaries that receive equal amounts of a total of $15,000 distribution, meaning each beneficiary received $5,000, but the DNI that was reported on the tax return is only $6,000 total, each beneficiary will get a K-1 showing their 1/3 share of the $6,000 or $2,000 of income that they must pay tax on, even if they received a distribution that was more than that. Also of note, if the DNI is negative or 0 and the person and the beneficiary still received a distribution, we still will issue a K-1, but it will state no reportable income at the top of it. And capital gains are paid at the trust level unless it's stated in the trust document. Those are paid at a maximum rate of 20%. I have seen trust documents where it says that the trustee has the option to pass out capital gains if it's more beneficial. Next, talking about irrevocable complex trusts. These trusts are indicated in the trust agreement that the trustee has the discretion to distribute the funds to the beneficiary. That means that the trustee can choose not to, in which case any income that there is going to be kept in the trust and taxed at the trust level. If income is distributed to the beneficiaries, then a K-1 will be issued to the beneficiary. If the trustee chooses not to distribute the funds, the income could be taxed at a max of 37%. We'll talk about that in a minute. Again, with this, an irrevocable complex trust, capital gains are paid at the trust level unless the trust document states that you can pass those capital gains out and be paid by the beneficiaries. And in the final year of both of these trusts, since they're irrevocable, all income and expenses, including capital gains and losses, will be passed out to the beneficiaries, and the trust will have no tax liability. A revocable trust is a little bit different beast. The income and expenses are taxed at the grantor 1040 level, not at the trust level. There's different options. The option to do a 1041 and prepare a grantor schedule, or the income can just be reported on Form 1040 at the individual level. Our office does see it both ways. It does seem like trust companies and banks like to see the additional return at the 1041 level, just to add another layer of separation to the assets. Back to talking about the income tax brackets of trusts. The tax brackets are very condensed, with the top tax bracket being 37% when $12,750 of income is in the trust. That would be for a complex trust where the income is elected to not be paid out. This is when we have to work together with our clients to discuss when distributions become crucial. We might have a potential for a partial distribution if it will lower the tax bracket and the trustee is authorized to do so. The theory behind distributions is that typically beneficiaries will pay less at the individual 1040 rate as opposed to the trust rate, unless all of the beneficiaries that receive a distribution are already in the 37% bracket. Since simple trusts have to pay out the income mandatorily, this mainly pertains to complex trusts with a discretion provision. Another complication that I see from my clients coming in is regarding the taxation of an estate. They have no idea what forms need to be filled out or which is applicable to them. There are two types of estate returns, and it's really a confusing concept. The 1041 we consider the small estate, and the 706 is the big estate. So the 1041, the small estate, if the estate, even if it's in a fiscal period, has more than $600 or more of income from any source, must file a Form 1041. We have to watch for distributions of income if the estate is open longer than 1 year. If it's only open 1 year, then it doesn't really matter because everything will be passed out on a K1 at the end of the reporting period. But the issue becomes we don't want to have a ton of income in 1 year, then close the next and not get to take the deductions against the income. In the final year of the estate, all income, expenses, capital gains, and losses pass out on the K1s to beneficiaries. To note, our office, you can always call or request a pre-bill for the final tax return. We're more than happy to do that. And if a 706 is not required, the beneficiaries still get a step up in basis on those assets at date of death. I'll talk a little bit more about that when it comes to the 706. So the 706 is the big estate. In 2019, it means if a decedent passes away with $11.4 million in assets at their date of death, then we actually have to file both a 706 and a 1041. The difference in the two returns is the 706 is a snapshot at the date of death of what assets the decedent possesses. The 1041 is everything from the day after the person passes away through the following reporting period. I get clients who come in and are confused as to why they don't have to file a 706, so I just wanted to touch on the requirements for that. If the person that passes away has $11.4 million in assets or more, we have to file a 706. For every dollar over $11.4 million, they pay 40% in tax to the IRS. It's kind of interesting how the inflation has occurred regarding the big estate. In 2010, the estate exemption was actually zero. You could have $1 billion estate and not pay $1 to the IRS for taxes. But back when I started doing trust and estate work in 2008, the exemption was only $600,000. The other reasons that you have to file a 706 you have to file it in order for a spouse to elect portability and to use a former spouse's DSU, which stands for a deceased spouse's unused exemption. So for example, a husband dies and uses $10 million of his exemption in 2019. When his wife passes away, her exemption will increase to include an additional $1.4 million from her deceased spouse because they filed a timely 706. If the client owes money to the IRS, then they have to pay it 40% over anything over 11.4 million. The other issue with a 706 is the step up in basis, like I said on a 1041. If a 706 is not required, you still get a step up in basis on those assets, meaning that they get stepped up to whatever the basis was at the decedent's date of death. So I like to say this to my clients. If your husband purchased UPS stock 20 years ago for $10 a share, and on his date of death, the share is now worth $100 per share, what gets reported on the 706 is now $100 per share. What happens is when a wife then receives that stock, she can turn around and sell it, and instead of having his $10 per purchase share that he acquired it for 20 years ago, she now gets his basis at the date of death, which is $100 per share. It saves a lot of tax money in capital gains if we get that step up in basis. There are a few drawbacks to filing a 706. It's costly. You have to have appraisals and valuations, and it takes lots of time to prep and get all of the documentation. But the consequence of not doing it, what happens if you don't file for portability purposes and the surviving spouse wins the lottery? They could have used the deceased spouse's DSU to offset assets in their estate, but because they did not file, it's not an option anymore. Or maybe more relative to our purposes and our portion of the nation, what happens if the surviving spouse has mineral interests that spike? What happens if they hit oil in the Bakken and we didn't elect portability, so now they are not allowed to have the DSU from their prior spouse? The exemption is set to go back to $5 million, adjusted for inflation around $6 million in 2026. However, there's been lots of legislation this year to try and claw it back to the $3.5 million range that didn't pass. Obviously, there's an election year coming up, and this is going to be a hot topic for all of the candidates. This is why gifting is at an all-time high. Wealthy people are trying to get assets out of their estate before the exemption goes back down. Legislation passed earlier this year eliminated a clawback, so the IRS can never punish someone for gifting all $11.4 million in 2019 if they want to, if they decide the exemption goes back down. One of the issues with gifting, however, is that when those assets are transferred to the donee, they're no longer eligible for a step up in basis as the donor is still alive. There's a lot of planning techniques that we can use with this, and we would love to help you and your clients work through this. As a recap, I just want to talk about some of the best practices. Always state the situs of the trust in the trust document. There's a lot of complex state tax codes right now that are causing states to get a cut of the tax if the trust instrument is silent as to the situs. South Dakota has some of the best tax code in the country, which is why we are thriving in the trust and estate arena. That, along with no state income taxes, makes us look very attractive to other potential out-of-state trusts trying to move here. If you are unsure of how to fill out the SS4, please contact a CPA office for help. We're more than happy to help you to get that done the right way. Also, think through the distributions to see if it makes sense, if they're allowed and beneficial, to try to save your clients some tax dollars if they don't need to be paid. If you have a client that has questions We are more than happy to sit in on meetings to discuss taxability and options with clients to see what is most beneficial for them and for their beneficiaries. I thank everyone for your attention today. I am more than happy to answer any questions you may have, either now or after the presentation.
Okay, right now we do not have any, I do not see any questions in the queue right now.
Okay.
Why aren't we moving now? Okay, there we go. Okay, my name is Elise Foltz, and I will be talking a little about the different types of legal entities. Some of what I have in the slides, I'm guessing you guys probably have fairly good knowledge about. I'm just adding it in to kind of have a basis to talk about the different entities. And there's not always a very clear-cut, easy decision on which type of legal entity to choose from. So it's not always, oh, limited liability companies are always the best. It's not always S corps are the best. There's a lot of things that you have to take into consideration when you're going to be choosing your legal entity type. So to start off with, we're going to talk about a sole proprietorship. Some of the advantages of a sole proprietorship is they're super easy and inexpensive to start. Generally, maybe the most that you have to do is go down and file a doing business as with your state. Some people may not even do that, so it's really cheap to start. All of the income that is generated generally goes to the owner to keep or reinvest, and they are also easily to dissolve if needed. Basically, a sole proprietorship is a legal extension of the person running the business. Disadvantages of a sole proprietorship is unlimited liability. So the person's assets, such as their house, cars, so on, are also at risk if something with the business goes wrong. The other issue is funding difficulties. It is sometimes very difficult to get outside funding with a sole proprietorship. It is also less attractive to prospective employees due to the fact that if the person that is running the sole proprietorship passes away or decides to dissolve, the entity is pretty much done and gone. So they have less stability for the employees. And like I said, legal extension of the person, so there's no difference between the owner and the business. On the tax side of a sole proprietorship, so the income could be put on different forms depending on the type of income. If it's business income, it is reported on a Schedule C. If it's rental income, it'll be reported on the Schedule E. If it's farm and ranch income, it is reported on the Schedule F. Farm rental is reported on a 4835. So the net income from a Schedule C or Schedule F is going to be SE taxable. The owner also will receive a above the line deduction for half of the SE tax, which reduces the taxable income, but then they pay the full SE tax. If you do a sole proprietorship, it may not be something that you stay in for a long period of time, because of the unlimited liability and often because of the SE tax, especially if you start getting large amounts of income. That SE tax can be a lot to pay if you have lots of income. A partnership is similar to a sole proprietorship, except for there's two of you, which means you also have to, but then you have to file a separate tax return. Some of the advantages for a partnership, it's easy and inexpensive to set up. You have shared financial commitment, which can also be a negative side of partnerships. Potential partnership incentive for future employees. So sometimes if you have an employee that's very dedicated and has been there for a long time, it may be something that you can very easily like move them into a partner of the partnership as well. Disadvantages are the joint and individual liability. And again, like I said, shared financial commitment. Another big disadvantage of partnerships is, yeah, you may be great friends going into this partnership, or you may, as a family member, may totally get along, but running a business together may cause that friendship to disintegrate. So disagreements among partners is difficult in a partnership. And then also in a partnership, you can share profits. Unfortunately, with a partnership, you can have legal responsible for the other partner's action. And then a partnership lasts as long as there are two partners. If one partner passes away or decides to get out of it, if it's only a two-person partnership, your partnership goes away and turns into like a sole proprietorship. But if you have 3 or 4 partners and one person leaves, that partnership still is there. And just keep in mind, all partnerships should have partnership agreements. I know there's quite frequently that we see a partnership come in and they don't have any kind of partnership agreement, which makes it really hard to figure out how we're supposed to file the tax return, because some partnerships split up how they allocate incomes and losses differently than just their ownership percentages. So tax consequences, this is where it becomes different from a sole proprietorship. The tax consequences is you are filing a separate tax return. You are filing a 1065. So partners share in the profits and loss and are passed out through a Schedule K1, which shows up on their personal form 1040 Schedule E. So partnerships are not taxed at the partnership level. They are taxed at the individual level. In a lot of the cases, partnership income can be SE taxable. The business income will most likely be SE taxable. Rental income will probably not be SE taxable, depending on the type of rental it is. The owner receives the above the line deduction for half of the SE tax, which reduces the taxable income, but then again pays the full SE tax. Then there are limited partnerships. And again, these are similar to partnerships, but there's a few exceptions. A limited partnership can have or has general and limited partners. The general partner has control and has joint individual liability, and the income that gets passed to him on his Schedule K1, him or her, the business income will be SE taxable. But then there are the limited partners. The limited partners can't have direct control and don't run the partnership, and their business income that is passing through on their K1 generally is not SE taxable. Limited partnerships, they're easy to attract investors because of the limited part of it, and they have limited liability to the business debts, and they can share in the profits and losses without having to participate in the business itself. So if you're looking to get like more funding, bringing in a limited partner is beneficial. Limited liability partnerships are slightly different. They're similar to the general partner, except for all partners have limited liability protection, but they are managed by all members of the LLP, and the partners are only liable up to the amount that they invested. An issue with this is not all states allow limited liability partners, depending on, or if you're a certain type of company. Okay, C corporations, this is not, we don't see a lot of C corporations in this area and in our practice that we do. Advantages, limited personal exposure for shareholders. They can only lose the amount that they invest of their investment. The C corporation can sell capital or can sell stock to gain capital. And that's generally how they gain the capital that they need to expand. And it's a completely independent entity that is liable for its own debts and actions. So it has not, like the C corporation has nothing to do with the individuals that own it as far as the liability. Disadvantages is it's very time consuming. There's a lot more paperwork that you have to put together to be a C corporation. It's costly to do all that. And then you also have the double taxation. And then additional paperwork and record keeping because of the regulations. So with a C corporation, it is taxed at the C corporation level. Unlike partnerships where they're sent onto the individual tax return and taxed at the individual level, C corporations are taxed at the corporation level. In 2018, it was changed that C corporation is taxed at a flat 21% tax rate. The biggest issue with C corporations is that any income passed out to the shareholders or to the shareholders ends up being a double taxation. The corporation pays the tax on the income and the shareholders pay the tax on the dividends that they receive. So that's one of the biggest disadvantages of C corporations. We have, since the change in the tax rate up to 21%, we have had a lot of clients question whether they should change from an S corp to a C corp because of this 21% tax rate and some of the individuals being taxed at a higher tax rate. And we have had situations that it might be better, but there's been a lot of situations that it has been better to stay as a C corp. So an S corp. So if you have an S corp that's questioning whether it should change to a C corp or a C corp that's questioning whether it should change to the S corp, have them talk to their accountant to kind of do a breakdown of what the difference would be tax-wise between the two. So S corporations, is a very popular type of entity to do, and it can have some really great advantages. Advantages that are taxed only once at the personal level, unlike the S corp or C corps. The income is passed through. It's not SE taxable. Only the compensation has FICA taxes on it, and I'll go into that a little bit more. Business expense tax credits. The corporation is independent from the shareholders. Disadvantages: there's stricter operational processes. There are corporate formalities. The requirements on shareholders' compensations and distributions must have a reasonable compensation. So one of the reasons that a lot of people like to switch to an S corp is because, oh great, I don't have to pay SC tax on all of my income like I do on a sole proprietorship or on a partnership. But you have to have a reasonable compensation. So some people will like, oh, a reasonable compensation is $10,000. No, not exactly. We need to take a look at what a person doing their job would get paid if they were not actually doing the work. There's charts and stuff like that you can take a look at and see. Or a lot of the times they have a general idea of what they need to pay someone to do the work that they're doing. The other thing that we like to look at is like distributions compared to their payroll. If they're taking like $100,000 in distributions but only taking $10,000 in payroll, there's going to be an issue there if the IRS comes back and looks at it. So you want to have the distributions, we like to say about 50-50, but it depends on each individual business. Another disadvantage of S corporation is it limits the ownership. You must be a U.S. citizen or resident, no more than 100 shareholders, and you can only have one class of stock. Where in a C corporation, you can have multiple classes of stock. So you have to be careful with that and make sure that you don't do disproportionate distributions with an S corp, because the IRS could look at that as multiple classes of stock. Oh, so I guess I forgot to put the slide in as far as the tax advantages of an S corp. And mainly what I was talking about as far as the tax advantages is with that when you pay your compensation, that is FICA taxed, but the remainder of that income is not. It's taxed just at your federal tax rate. So for example, if you have, for a sole proprietorship, if you had $100,000 of income, you would be SE taxed on all of that. So instead, we move it into an S Corp. What if we take $50,000 in payroll and then $50,000 of income? So you'd save you'd save SE tax on $50,000 of income. So that's one of the big tax advantages and can be a huge benefit for people that are making a substantial amount of money in their corporation. So the last one that I'm going to talk about is a limited liability company. So, this one tends to be the most popular for startups. It's kind of a hybrid between sole proprietorship, partnership, and a C Corp. Some professional locations in some states are not allowed to be an LLC. In South Dakota, you'll need to file with the state and likely has filing requirements. And an LLC likely has filing requirements in most states. You'll just have to, if it starts up in a different state, you'll have to check the filing requirements. With a limited liability company, there needs to be a written operating agreement, articles of incorporation, and there's limited liability for the members. So there tends to be a lot of confusion in, I have a client come in and says, I'm a limited liability company. I say, okay, great. What kind of limited liability company are you? Are you a sole proprietorship so that I'm reporting on a CE or F? Are you a partnership or are you an S Corp? So you can be any of those things. So, and then a lot of the time they're like, I'm not sure. So then we have to kind of ask more questions. Obviously, if there's two people in the LLC, it's either going to be a partnership or an S Corp. And then that's the other thing is like, and when we're doing 1099s and so forth, if you're a limited liability, if it's an LLC, whether we prepare a 1099 or not depends on what entity type you are as well. So another reason that we have to know whether you're a partnership, S Corp, or a disregarded entity. So one of the issues that we have been coming up a lot is when doing an LLC, we'll have the lawyer will prepare the LLC and they'll have both the husband and wife as members, when in reality, what they were kind of wanting to do is just doing a Schedule E. This is coming up a lot with like the Airbnbs, where they're starting an LLC for the Airbnb and they fully intend on just having it as a Schedule E on their 1040. But when it's set up, they set it up as a husband and wife. And that's not, if we set it up as both husband and wife owning it, it ends up having to go on a 1065, which costs more because we have to do another tax return doing the 1065 and the 1040. So when you're looking at setting up a husband and wife LLC, you need to kind of consider, do we really want it going into a partnership 1065, or do we want to keep it on a Schedule E? If you want to keep it on Schedule E as a 1040, then you'll just want to do one of either the husband or the wife owning it, so that we can reduce the number of tax returns that need to be done. Any questions on legal entity types?
I am not seeing any questions in the queue right now.
All right, we will move on then. So let's get into a little bit of dealing with the IRS and IRS resolutions. So I want everyone to kind of keep in mind here that this is supposed to be a win-win situation. A lot of the reasoning behind this makes sense if you keep this part in mind. If you have a client who has a lot of assets and the ability to pay a tax that they really owe, it's not a win-win situation to the IRS if you want to offer less than they owe, that type of thing. Additionally, that really comes into play when you look at the statute of limitations. So keep that in mind as we go through this. So tax problems can stem from many different causes. I'm sure a lot of you have seen these things. I did want to point out that first one especially. So government errors is huge. I don't know how many of you know, but a lot of the processes at the IRS have been automated and use a form of AI. You'll notice like the notices that you'll get from the IRS, they'll have a CP and then the number of the notice after it. The CP actually stands for computer paragraph. They're just showing you how much it's not done by people. Letters being sent in, different things like that. So some of the time the error can just be the computer didn't know how to read it, or there was a key word the computer was looking for that you didn't specifically spell out. It didn't see that keyword. We also see a lot of things here in letters. These are also often read by computer intelligence. So a good example is a first-time abatement penalty relief. If the letter is stating something along the lines of the client has no issues in prior periods, so need penalty relief, it never says first-time abatement. The computer program denies it because it doesn't pick that up. So other mistakes that we want to see, not specifically listed here, would be things like the IRS accidentally put it to the wrong taxpayer, common name, common issues there. So it might not even be their debt. It could have just been a missing statement when it was sent in, some piece of the tax return didn't get filed. Maybe it's missing the second page of the Schedule E, and there's not a huge issue other than you have to refile. Then there's things that we see often about information being reported where the computer doesn't expect it to be reported. So a good example of this is with our 1099s. If it's filled out incorrectly, a 1099 is sent in for the client and it lists the income as non-employee compensation. The computer is automatically going to look for that on the Schedule C. But the client really knew it was for rent, so they reported it on their Schedule E. And now the computer has a mismatch and they'll get notices and letters that they didn't claim all their income there. So the first thing to look for is always either government or taxpayer errors, and start with that. Another big problem that can come up and cause bigger ones is if a return was not filed, the IRS can do a substitute for a return or an SFR. In that case, SFRs only really have the income that was reported to the IRS. There's no way for the IRS to know what the expenses were. And so that's often an overstated tax bill. And there's times it's better to amend or to file that return to replace the SFR. In that case, it would not be an amended return. It would just be filing an original. For the other ones, if the taxpayer did their own, we see a lot of issues that way where a taxpayer tries to do their own return, especially on business returns, and have no idea what they're putting there and where. And so you may be able to fix a lot of the issues just by filing a correct amended return. So letters to work as well. We've recently had cases where like a home sale was reported and put on the statement, but the computer didn't pick up the statement showing the home sale was reported. And so when we didn't include that income in the computer's eyes, they would send that out and we just had to send back proof. No, here it was reported here on the statement, because those, when it's sent back, are read by an actual person, so that can be looked at. The other things here, you guys see a lot of divorce frequently comes up with IRS issues, especially if one spouse did or did not know, and there's issues with that. We really won't go into injured or innocent spouse today, but just things to keep in mind. Those are things that may be worth looking at. Reversals of business, as prior mentioned, if they thought they were an S corp but now paid out and have different classes of stock. The IRS kicked them out of being an S corp, and they can't apply again for so many years. Health problems that came up, now they're no longer working, or they're paying huge medical bills and can't pay their tax. And then frequently, most of the time we see is the sticking their head in the sand. They get the letters or the notice and they just ignore it, because if you ignore it, it must not actually be an issue. So those come up a lot in the issues we see. So some of the options for this. So these here are all assuming that they owe the tax for the most part. So we'll cover if they don't, if it was the wrong taxpayer, things like that coming up. But for now, simplest, if it's a substitute for return, it makes sense, file that original. If it's an incorrect return, to amend it. After that, if they can, just pay it. That's the simplest, the quickest way that they're going to get done with their issues. It's going to charge, the sooner that's done, the lowest amount of interest and penalties, as interest will continue to accrue and the penalties continue until it hits the maximum. So it's quickest, simplest way. If they can't do that, it may be worth looking at financing assistance. If they have the assets and the ability to pay, just helping your client through that, other ways that they could leverage their assets. So I have bankruptcy listed here. I want to touch on that briefly. That one will also not fully be covered in here because there's a lot of nuances and differences in that. But a really simple must keep in mind thing is that tax debt is only dischargeable in very specific circumstances. It must be 3 years past the due date of the return. You need to pay attention to whether they filed an extension or not when looking at that due date. The return has to have been filed for at least 2 years. And then the tax actually has to have been assessed by the IRS for 240 days minimum. Without those three, it can't be discharged. So things to keep in mind, if they're coming close to that 3 years and you need to wait another month or two before you start filing, make sure you're watching the statutes in those types of situations. Additionally, that substitute for return, if the IRS did that, that tax is not dischargeable in bankruptcy. So that's one of the cases where it may be worth filing that original return. The caveat to filing the return is there are some court circuits that will not count a late filed return as dischargeable, even if you still do it. So you really want to look at the court you end up working with on that. And then one last thing on bankruptcy is trust fund penalties. When we get into payroll tax issues toward the end, those are also not dischargeable for the trust fund portion, which we'll go into later. But the other issues there, we'll talk about more in the upcoming slides, so I won't go through them now. All right, so before we get into it, the statute of limitations is very important to watch. The two big ones that you're going to see are the ACED and the CSED. So the ACED is the assessment of the tax, and that must be done within 3 years. The CSED is going to be 10 years from assessment for the collection statute expiration date. The ACED is really going to come into play. Mostly we'll see that with the payroll tax, that trust fund penalty. So we'll talk about the ACED more later on. The statutes really are going to matter for appeals. Taxpayers and your clients have the right to appeal, but the process is going to be different if there's less than a year left before the statute runs out. The IRS is trying to push things through before the statute runs out, and so they're going to be less willing and less helpful, and you just have to approach it in a different way. And don't be surprised if they try and ask you to extend the statute so they have time to fully go through the appeals process. Additional things in here is that certain things of these remedy options are going to toll the statute. So they'll temporarily halt it, usually while it's being processed and it's pending, and until it's accepted or denied, plus a period of time. Most of those have a 30-day period of time, but certain things such as bankruptcy will actually extend it out for 6 months after the decision or after the pending bankruptcy has been finalized. So if you file a return and it hadn't been 3 years when you file bankruptcy, now that tax is sitting there with the toll pended for the whole bankruptcy period plus an additional 6 months. So when you try and remedy that tax, there's going to be some different things you have to watch out for there. And it may go a lot further than you were otherwise thinking it would. So a good time of why these, or a good example of why these matters. Let's say the IRS did a substitute for return. You file an original return so you can include the expenses and decrease that tax debt. The tax was reduced, so the old CSED stays in place. It remains. It's less. The 10 years doesn't revert back to a new 10 years. It just continues on for whatever's left. However, if you end up trying to file an original return, let's say so that you can wait, you're doing it as a planning, it's likely the taxpayer may file bankruptcy in the future, so you file this original return so that tax could be discharged at bankruptcy. Let's say they have a higher tax now once you report all of their income and not just what the IRS already knew about. They have a higher tax. There's a new 10-year CSED began on that higher tax amount, the difference between the two. So it can get a little confusing there in what is running out of statutes or not, and really need good transcripts and knowing how to read them to make sure you're not running up against something. There has been cases where the representation has been sued because if they would have waited a month to file something or would have waited, they would have had statute of limitations run out, and now the client is liable for extra tax because you weren't watching that. So hugely important, not only for your client, but also for your own personal protection to know about statutes. All right, so let's get into some of these remedies. The offer and compromise seems to be the one most heard about, so I put it up front. This is the one that is on the radio all the time of settle your debt for less, that people call you about or call in about knowing how they can do this. So there's multiple types as to this. The first one I want to talk about is that doubt to liability. So this is that offer or compromise if it's not their actual debt. This is one, when you submit the offer, you submit proof of why it's not them or it's not their taxes that's due. You still cannot put a $0 amount in the offer, so you always have to offer $1 on these type thing. I want to offer more. It'd be dumb to give them extra money, but there has to be a sum there. So make sure that you put the $1, it'll automatically be denied and you've got to start over in the process. And who knows how long it sat on a desk pending before they got to the case that now you're waiting again. So outside of the doubt to liability, there's still multiple others. The most common is the doubt to collectability, the reasonable ability of the taxpayer to pay. This is usually due to financial issues. There's a doubt as to collectability with special circumstances, So this is a case where I could pay, but I have such and such going on where the taxpayer can. Another one that gets often forgot about is an offer and compromise for effective tax administration. And this would be when the IRS charging this would cause an undue economic hardship or be detrimental to the future voluntary compliance of the taxpayer, their ability to keep going. An example of this that comes up is somebody who's in older age, closer to retirement, having to look at future supporting themselves, oftentimes with health issues. They may have the assets now, but if you take those, the government's going to end up supporting the person through their retirement anyway. So it's not always beneficial, and it may be more effective to leave it with the taxpayer and to settle for less so that the government's not just paying for it in a different way up front. Or later on, excuse me. So with the offer and compromise, they pay what they can afford. You do have to do full financials. You always report all of their financials. Don't try and hide anything, and don't let them try and hide anything. And then there's ways that even though it's reported, it may not add to the offer. There's certain instances and circumstances for all of it. An example of this, you want to put the full value of the house, but if the house is already held as collateral on a liability that has first dibs on it, then the IRS couldn't get it anyway, so it's not going to affect the offer in that case. Offers are paid over, there's two ways to do it. One's called the lump sum, and that one has to be paid over 5 months. The other option is to pay it over 24 months. Now, a lot of people don't realize when they do these forms that those don't have to be equal payments. And so money that they're paying while the offer is pending doesn't always come back to them. There is ways to designate that on the form, but so it's a good idea, especially if you're doing the 24-month one, that maybe you put $100 per month while it's pending with a balloon payment toward the end of it, or they step up later on. So you may want to start with the 24 months, put a balloon at the end. You can always look at reverting that after the offers to a point it can be accepted. It's no longer pending, and you know it's going to go through, so they're not throwing money at something that's going to get kicked back to you. The other thing to pay attention to is you're going to want to designate payments. So if they do have payroll taxes, you always want to designate. They go to the trust fund penalty first. And then after that, usually it's best to look at designating them to go to the newest tax first. Seems a little counterintuitive, but there's a longer time for the IRS to max out penalties in that case. And so the older debt may have already maxed out penalties, and there's no harm not as much harm for it sitting there. So usually newest tax is bested there. Offers and compromises can be streamlined. Usually if the income is up to $100,000 for the taxpayer and the tax liability is less than $50,000, it's a little quicker to get the streamlined ones through. You average closer to the 6-month time frame, or if they're not streamlined, you're looking at usually 8 to 9 months before you're getting something. And then the IRS will negotiate on these. It's not uncommon to see things like them wanting a collateral agreement. So they might say, okay, we'll settle all this past debt for this amount, but if the taxpayer makes over X and X dollars per year for the 3 years after we accept this offer, we want 30% of this over amount, which you can go back and negotiate and deal with as well. Don't forget in here, representation fees are an allowable expense, so make sure you're getting paid and make sure you're putting that in there. And those fees that they're paying can actually help reduce what they have to pay in their tax debt as well. So you can make sure you get paid first, which is a really nice kind of extra benefit to doing this work. And then once it's accepted, and to even get accepted, the taxpayer has to be currently in compliance. So all tax returns need to be filed. A substitute for return does count as filed if there's one of those for the year, but they can't have any recent returns that they haven't yet done. For example, right now, if they haven't done their 2018, they have to file that first before the IRS would ever consider it. Also, you'd want to do that so you can wrap that debt into there. They have to stay then compliant for the next 5 years. So for 5 years after the offer, they have to file timely tax returns. There's ways sometimes you can even build your fees for those future year tax returns into that offer, so you make sure it gets done because they're required to stay in compliance. They need to be making their estimated tax payments if they don't have enough federal withholding held out of a paycheck or don't get a paycheck. They need to be making those estimates so the IRS won't even consider the offer. It'll have sat on somebody's desk and they'll throw it back to you. But otherwise, it's pretty straightforward. The IRS looks at everything and they probably know more than you think they know. It's also ways in here, you really want to confer with somebody who's done offers and knows what they're doing on them. So a good example of this is that for the bank account, when you're reporting their financials on their bank account, if they have cash at home and cash in the bank, then they get a percentage, not even a percentage, it's more like monthly expenses can go against the bank account, and it could make the bank account look negative to the IRS, but they can't include the cash at hand. So it's simple things like even recommending that they deposit the money at home into the bank may help lower their offer when it's all said and done. So there's lots of little tips and tricks and best practices that you really want to work with someone who knows what they're doing on these and not just anybody reading the form, because those things are not in the instructions. All right, let's go to installment agreements. These are a lot more common. Installment agreements is just spreading it out over time. The interest percentages, they're not current, they're just an example. I think those are from about a year ago. I didn't update it for this because they're posted, they're published out there. But this is spreading the payments out, letting them pay during this time. They still need to be making those estimated tax payments, still need to stay current, or their installment agreement can default as well. And then they would have to apply again after they've gotten back in current. And the more they do that, the less likely the IRS is to agree and work with you on it. While they're in an installment agreement, or while the form's submitted and before it's accepted or denied, it does toll that statute. So it would have the pending period plus the 30 days that it's told when looking at your statutes. However, the benefit of this is that it does all stop any levies that are out there as well. So if you need time to put together some other sort of abatement relief, such as an offer, then this would stop any levies from happening while you're gathering all the financials to be able to do an offer. So it's a good tool to keep in your pocket. At the bottom there, I put that partial installment, partial pay. So if you submit one where in the 6 years that you can extend this out to, it's not going to pay that debt in full. For what they can pay every month, you would have to do financials with this. It's a different form than the offer type financials, but if you submit financials with and they can't pay more than this amount, you can set it up to do a partial payment installment agreement. With that, the IRS will review them. They say every 2 years, but they can do it annually if they have time, or if they think the taxpayer may have the ability, they'll do it more often. There are times in there too that they'll ask for the statute to be extended as well, up to 15 years instead of the 10 years, if they think the client will have the like a lump sum income payment type thing or something starting right after the 10-year mark. An example of this would be somebody in like a medical school where they have the school and the residency, and 8 years later, they're probably going to start making decent money. The IRS will work for things like that. Installment agreement forms is very important to read what you're doing. I currently have one sitting on my desk that the client tried filling out themselves, and they put in there that they would pay $41,000 per month for their installment agreement, which was not their intent, but they didn't read the lines correctly. And it's really common that we see that. So things to watch out for. All right, currently not collectible. This is not permanent, but it's where the IRS will send you if they don't think that you can pay anything. It lets it sit out there. They can come back at any time. They can decide that at that point they want to levy then. During this time, they will put a lien on there to protect their interest. Again, goes back to that win-win. They want to make sure that they're covered and protected if something big were to happen. But they won't levy while the client is in the status. They can come back at any time. They review it. It says annually. Sometimes they go a little more if there hasn't been big changes, but they are able to do it annually. And then the collection statute is told only while this is pending plus the 30 days, then it does continue to run. So this is an okay option if the statute is close to end date and the client really can't pay. If the statute is going to run out anyway, it doesn't really matter if interest and penalties still accrue. But if there is going to be future income that would kick them back out of this, now their bill is going to be that much higher because the interest and penalties do still accrue during this time period. Reasons taxpayers get here a lot is when the government can't find the taxpayer. They'll stick them currently not collectible kind of forever. If the statute of limitations expired, it doesn't really disappear. They still look at that for history. Of whether this is a habitual offender type thing. Same if there's a death with there's no estate funds, or it was a defunct business, or hardships, or kind of things. It can be requested. If the IRS hasn't done this, you request it with those financials showing that they really have no ability to pay. If you're waiting for that statute to run out, that could be a way to resolve their issues. The only thing is they'll still continue to get letters and notices, so you need to make sure they're aware of that. When the IRS reviews this too, they look at only total positive income for whether they want to look more into it. And so with that, it's only the positive numbers listed on their tax returns without any of the deductions or losses or credits that they were allowed to take. They just want to see, are they making money that we think we could reasonably try and get some of. All right, so other remedy options, just briefly. So penalty abatements are a big one. The first time penalty abatement would be if they've had a clean record for the last 3 years. If it's been 4 years since they've had any abatements, then they could apply for a penalty abatement again. So the name's a little confusing there. But if they have penalties in every quarter for payroll tax or every year, the IRS may say, well, you've never been abated, but you also haven't been compliant, so they can deny it for those reasons. Another penalty abatement would be a reasonable cause. This would be things like disasters. Hurricane Katrina destroyed all my records, so I couldn't get those in a reasonable amount of time. It can also be things such as I relied on the advice of a tax practitioner or the legal practitioner. They had told me I wasn't required to file, so I didn't, or told me I didn't need to pay this, things like that. If they have documentation and evidence of it, they can put that through. It doesn't really work usually for late filing, but can work, or not, excuse me, late paying, but it can work for late filing. With that, it is the penalty only. That does not abate the interest. Not listed on here, there is a possibility that you can get an abatement of interest. This is usually when there's an error by the IRS. They will automatically take that out. It's supposed to be automatically, but if their computer system glitches on that automatic process, then you may have to request it. There's also, if you can prove that the delay was for them. I sent them everything on this date. I have certified mail tracking that they received it here, but they waited 8 months to process it. You can request that penalty abatement there. A lot of times a good way to find this out is to do a Freedom of Information Act request to get the audit work papers. We've even had one where when we requested the work papers, the IRS couldn't find them. There's no longer the burden of proof, so we immediately requested all the interest be removed, and it was abated. So when we talked about that partial installment payment, levy reversals, they're not common, but in special circumstances after a levy, and if it's done right away after, we've been able to contact the IRS and say, hey, we just need you to put the money back because the client has such and such upcoming. Huge medical bills, huge health issues, things like that. They really need that money and we're working on, so here's our installment plan payment paperwork instead, because they're going to pay you or pay over time, which also buys you time to do some other remedy solution. Now we get into even just being able to offer business changes and advice. If the issue is coming from, let's say it's an S Corp and the business is really defunct, it's not going to be profitable in the future, it may be worth shutting it down and doing some of those changes type thing then, and helping the client work through that process and see if the IRS will look at getting rid of, depending on the company type, getting rid of some of the debt just with the business itself. Other things that you guys can do to earn your fees, there's the lien side. So once it's paid, that lien will be released. But if you have a client who needs a lien withdrawal, that can be requested once it's paid in full. You can request that they take it off. This works especially well if there's some type of certification they have or license where their credit check matters. A good example we've seen here is like architects. It can affect their ability to work in certain areas, so requesting that to be withdrawn so it's removed from their credit statement. And then you just talk about that win-win with the IRS. And so this would be the case where you would say, hey, you're going to affect their future ability to stay in compliance and pay you if you don't do this. So that's a big thing to look at there of getting it withdrawn. You can request that too and things if you want to talk to the IRS about like, well, they would be able to sell this and pay you if, so things in those cases where you can talk about how it's a benefit to the government and they're more likely to do that. So just to keep you all awake, everything is theirs. So, all right, tips and best practices for you guys as you go through this. So a lot of people have done the power of attorneys and jump right there. So it's not a bad idea before you agree to represent someone instead to fill out the 8821. This is information only and will let you see what they have going on. Make sure there's no hidden skeletons you don't really want to represent. It's a good thing to look at first. You're not able to do anything. A common practice for me is that I have them sign both in my office. I send in the 8821. If I call, if I think I can do something, then I will, while I'm on the phone with them and they say, oh, you can't do that, you only have an 8821. I say, what's your fax number? Let me send it over. So I'm ready if I decide to represent, but I don't have to take them on. The power of attorney is not valid till it's actually received by the government. So in that case, it could sit in my file and just stay there and not actually be valid. Make sure that you're doing something while you process your options to halt the liens and levies. If it's new enough in the process, it may just be contacting them and putting that power of attorney in place. Often it's doing something like that installment agreement with a lower initial payment. So then you have time to do the rest of it and they're not hurt during that time. You're gonna have to gather all current financial information. If it's a sole proprietorship, it will go right on the same form. If it's any other type of thing where it's filing its own tax return, you're going to have to do separate financials for both, and they'll want both when you send it in. You need to make sure that they're current and that nothing is delinquent. They're making their estimated tax payments. And then you generally just want to do that OIC prior to deciding on a bankruptcy. Wipe out as much as you can there, because depending on how long it's been, you may not be able to discharge the debt through bankruptcy where you could through an OIC, because you don't have that same 3-year time period. When you do those offers, you really want to include all tax years, so it just makes sense that you include everything that the bankruptcy can as well that way. And then the IRS is going to be a lot more willing to accept all of your suggestions if you're willing to set things up in an automatic withdrawal. They like having that ability. One other thing to point out, if you want to know how many powers of attorneys that you have out there, you can do a Freedom of Information Act to get that. So keep that in mind, that there's ways you can still get that full list. They will automatically fall off if somebody else puts one in place, and there's certain years they kind of just naturally fall out of the IRS system, usually after 10 years, but that's not always the case. So it's good to sometimes see what you have out there and make sure there isn't any sitting there from old years when you had worse habits that you need to revoke. Great, so speaking of power of attorneys, quick, just some best practices quickly to go through there. Each taxpayer needs to have a separate form. If you're doing a business and a married couple, you'd have 3 then. So make sure you're doing one of both. You can't list multiple people here. If there's multiple businesses, each will need it. So put that through there. There's really no reason to ever list the client's phone number. You can put yours. Some people write POA after it. You can just write yours. You are stepping in on this one as that representative, so you don't have to get that information. I don't have, and that updated on the tab, the updated on, we'll talk about when you would do that in a little bit. That wouldn't be the first time you're doing it though, but I wanted to put it there just so you could see where it goes. The second section I don't have a picture of on here, but in that section is where the representative goes. If you've never done one, you don't have a CAF number to represent in front of the IRS, you submit it with that blank and the government will automatically know to send you a letter. Usually takes approximately 6 weeks to get that CAF number. During that time, you really want to try not to send in anything else with a blank CAF number, or you could end up getting assigned 2, which causes confusion and it's hard to get rid of. So make sure that once you've sent your first, you're kind of trying to wait that 6 weeks. If you don't prepare returns and you're not required to have a PTIN, that is not a requirement in the representation. You can just leave it blank if you're not required to have them. So then later down, the things you do, we typically do the next year and 3 years prior. You can go up to 3 years ahead of time. And there are instances where you may want to go back 10 years, such as for those collection statutes, to see where it's at if they have older issues as well. The bottom half there, that check the box for the intermediate service provider. This is now mandatory if you're going to use any additional third party to help pull the transcripts into reports, which is often done. And then the other ones on there, right below that is a substitute or add representative. This one's a good one to add. This would give you permission without the client signing a new power of attorney for you to fill out a new power of attorney form to give such as a coworker or another partner in your firm permission to have that power of attorney while you're on an extended leave or out of the office. Or if you're going out of the country type thing, you're going to be hard to reach, or the client's out of the country, you'd be able to do this without having to have the client re-sign. You would have to make sure that you've kept the prior power of attorney in effect. To do that, that's the top of the next page. You'll see the little red box. This slide is not in the ones that we had sent out earlier if you've already pulled them. So I want to make sure you knew that. But in here, if you want to keep a prior representation, a good time that you guys might be doing this is for that coworker when you're signing the power of attorney, because you've allowed that substitute on the original. Or if you guys are adding on when the CPA you're working with already has a power of attorney in place, you want to make sure that you're not doing theirs. This is when you'd want to put that updated. Additionally, you can have up to 4 representatives on the front. You'd put that updated on the top if you were, say, adding a third and you only had 2 there originally. Keep in mind that there can only be 2 people on power of attorneys that are receiving notices. So if you're doing this second power of attorney and you want notices and you put a coworker on the front of the page and say they want notices, you've now taken it away from whoever's power of attorney you're keeping and they no longer are getting them. One workaround for this is that a third person you want to have notices could fill out an 8821 instead of a power of attorney. And that would allow them to get the notices too. But make sure you're paying attention to that. Otherwise, you may think your CPA is getting notices when you have them all. All right, really quick on businesses, you must enter the title. The title needs to correspond to the type of business it is. So if it's a corporation, things like president. If it's partnership, managing member. You want to make sure it's applicable there. If they just put owner, the IRS is likely going to kick it out and not accept it because that's not a business title that they recognize. So make sure it's there. Those are just left blank, both of those blue boxes, if it's an individual. All right, and then just really quick, the new one supersedes the existing unless you've marked the box to keep it. You would also have to, in that case, include the original one that you're keeping in place with the new one. So you want to make sure to get a copy of that. This allows you to step in the shoes of the taxpayer. So you must know your taxpayer and what the offer is that's happening and if the client's going to agree to it. It is sometimes, unfortunately, dependent on who you're actually speaking to. So they might offer you a good deal, but if you have to get off the phone and talk to your client, you can't get back to the same person. You may not get the same offer when you call back. So you really want to make sure that you're able to do it. You also cannot receive refunds for the client, so make sure that any refunds or things that you're getting are being sent directly to the client. They can, if it's a paper check, be mailed to your office for you to give over, but never have your bank account attached to it or your business bank account. And then they are, for the most part, think of them as staying in force until they're withdrawn by either the taxpayer preparer or another preparer in the future sends in a new one. But then you wouldn't know if it happens, so do that for you. And lastly, really quick, trust fund penalty. These are for payroll taxes. The trust funds are the funds that are withheld from the employee's paycheck. It's not the entire amount of payroll tax due. This would be the federal withholding and then their portion of the FICA taxes. The trust fund penalty is that this can be assessed outside of the business and against the owners of the business, and it can go 100% to each owner of the business. The IRS really doesn't care who they collect it from. They typically try and assess 100% to everybody they think could be responsible, and if they can get it from person A or person B, doesn't matter to them. Person A and person B can fight that out in court afterwards in the IRS's mind. So this is why you want to designate that the IRS penalties go there, or the payments, designate any payments go here first, so you can try and limit it being assessed against people personally. A good one here is your ASED to watch. If the business filed the return and timely, the tax was assessed 3 years ago, this trust fund penalty was assessed 3 years ago. It's been 3 years now. The IRS is outside of its statute to assess that against the individuals, but they'll still try. So that's mainly when we see the ASED come up. And then these are also not dischargeable for bankruptcy. So if there is lots of trust fund issues, you're better off doing an offer and compromise instead. They also have to be both responsible and willful. So if you can eliminate either one of those, then you can eliminate it. And then just to be aware, this can be assessed against anybody found to be responsible and willful, whether that's an owner, a bookkeeper. There's even court cases documented where they were able to charge it against a banker or an attorney who is making the decisions on behalf of the client or the business. So watch out and protect that there and make sure you're looking for it. It's pretty common for you to get pulled in to represent somebody like a bookkeeper and having to prove how they weren't responsible or willful. So I'll open it up now for any questions.
All right, I'm not seeing any questions in the queue here right now.
Okay. Well, if we don't have any questions, then we will keep going. So now we're going to talk about what has changed in tax for 2019. So here are 2019 tax brackets for single and head of household. They haven't changed much from 2018. They were just adjusted for inflation. I did want to point out one thing here, between the 10% and the 12% tax bracket is where your benefit is from being single versus head of household. But after you hit that 22% tax bracket, then everything is the same after that. So head of household would be single parent, things of that nature. Married filing joint versus married filing separate. Again, not much change, just adjusted for inflation. Things to note on these tax brackets: your capital gain bumps up to 15% at that 78,950 rate. And your QBI, your qualified business income deduction, will start to phase out at that 321,450 on the married filing joint side. So that's where we will start to lose that. And the one item to note is these are just, the married filing separate is just half of the married filing joint. The rates are the same, just divided in half. Now, the marriage penalty, as you can see on the two slides before, a single person won't reach the top 37% tax bracket until they get to $510,000 in taxable income. But a married couple, married filing joint, reaches that top bracket at $612,000. So there's only a $102,000 difference between the two, even though there's two people. So two single people could have over $1 million in income before they reach the top tax bracket, but a married couple will reach it $408,000 sooner than that. So that's what we kind of call the marriage penalty there. Here's our list of standard deductions. Again, just adjusted for inflation. Went from $24,000 to $24,400 for married, up to $12,200 for single, and $18,350 for head of household. The standard deduction for the elderly and the blind is unchanged again this year, so that's been the same for several years. These are our automatic cost of living adjustments. These change pretty much every year. The things in gray did not change, so a couple of them didn't change. But our IRA contributions went up by $500. Your 401k went up by $500. The standard mileage rate went from 54.5 to 58 cents, which was actually a pretty big jump this year compared to other years. But as you can see, the other ones, again, just adjusted for inflation. No big changes here. All right, 2019 specific changes. That was a new form called the 1040SR. And this is the short version of the 1040 for taxpayers over 65. We used to have the form 1040A, but in 2018, the 1040A and the EZ were both eliminated as part of that Tax Cut and Jobs Act. So the 1040SR is for people who are over 65 and don't have self-employment income reported on a Schedule C, E, or F, or a partnership or S Corp. You can't have any of those to be able to file the 1040SR. And last year with the Tax Cuts and Jobs Act, you saw the form 1040 was the simplified version, we say with tongue in cheek, and we had 6 schedules that went with it. This year, they got rid of the Schedule 4, it went into the Schedule 2. The Schedule 5 moved into the Schedule 3. And the Schedule 6, which was foreign, with the foreign address, has been eliminated. So they shrunk it back down a little bit and theoretically are simplifying it again. We also have a new form for the QBI deduction. That's the $89.95. This is for anybody with income below that $321,000 married or the $160 single. And the form 8995A is for people that have higher income. Now, we haven't seen the final version of this form yet, but it's supposed to be the simplified version of the QBI calculation. So that's remains to be seen, but we will keep up on that one as we learn more. The penalties for not filing 1099s is going up again. It's $110 per 1099 if it's not more than 30 days late, but it's $270 per form if it's filed after August 1st. So making sure clients are on top of their 1099s is pretty important because this can get quite costly quite quickly if they're not paying attention. If you itemize rather than take the standard deduction. Now with the Tax Cuts and Jobs Act last year, it changed drastically the number of people that do itemize. It went down significantly. So not very many people take or itemize anymore. More people take the standard deduction, but just in case they do itemize, here's some items to note. So state and local taxes, this includes things like income tax, property tax, and sales tax, but it's limited to $10,000. And this could potentially hurt higher income or people who are in the higher tax bracket because it will stop their deduction at $10,000. And several states, New York and New Jersey included, passed laws allowing the taxpayer to make a charitable contribution and get a state tax credit for that. Now, obviously, that doesn't affect South Dakota at all, but it does happen in a lot of other states. But an IRS regulation disallows that charitable contribution if you get a state tax credit. So that's items to note. You might be able to get that credit on the state side, but then you're going to lose it on the federal side. But property taxes for trades or business are still deductible, rentals, farms, and all of the things of that nature, those didn't change. Alimony, this didn't change from last year, but it is a little bit different, so I wanted to make sure that we pointed out. For any decrees after 12/31 of 18, alimony is not deductible to the payer, and it is not, or it's not taxable to the recipient either. Sorry. Decrees in effect before the end of 2018 is deductible to payer and is taxable to the recipient. If a decree is modified after 12/31 of 18, the new rules apply. And the new Form 1040 will ask when the divorce decree was entered so that it knows whether it should be looking to deduct or not. So that's kind of handy, actually. Community property states. South Dakota is not one of these, but we have clients in several of these states, so I thought it would be important to point out. Spouses that live in a community property state have to report half of their total community property income, even if they're married filing separate for federal income tax purposes. That's part of the new IRS publication that came out in January of 2019. So the community property states are listed below. So just for FYI, not applicable to South Dakota, but it is applicable to neighboring states. Sale of your residence. We have a lot of these that come up, so I just wanted to point out that the sale of a residence by a disregarded entity is still eligible for the exclusion of the $250,000 or the $500,000 gain. A disregarded entity is usually a single member LLC or a revocable grantor trust. NOL carrybacks have been eliminated for everything except farm and ranch income. Farm and ranch income can be carried back 2 years, and then NOLs can be carried forward indefinitely. And the NOL deduction is limited to 80% of taxable income according to the IRC section 172A. Oh, wrong way. There we go. I have some slides in here about farm and ranch. We have a lot of those in this area, so I thought these things might be important. Farm and ranch machinery is now a 5-year property instead of 7, and you can use the 200% declining balance for depreciation instead of the 150, so that's going to speed up our depreciation on those. Farm buildings, other than single-use buildings, are 20-year and eligible for 100% bonus. 20-year property cannot take 179. And single-use structures are 10-year property. These are things like grain bins, calving sheds, hog sheds, but they are eligible for the 179. So the general rule of thumb for what is a single use and what is not, basically, if it has a concrete floor, then it's a 20-year property. So it could be used for multiple things. You could park your tractor in the barn, but you could also store your horses there, things like that. If it has a dirt floor, then it is a 10-year property. So that's those calving sheds, things like that. General rule of thumb. Section 179 can be dialed into whatever amount you want. So you can pick any limit or any dollar value up to the 100% with the 179. But bonus depreciation is all or nothing. It's 100% or zero. So that's the difference between the two of those. And with bonus, it's by class life. So if you have 6 assets added at that are 5-year property, you have to take bonus on all of them or none of them. You can't just take it on one asset. And the ordering rules for those are first you take 179, then bonus, and then regular depreciation on any remaining balance. Like I said before, bonus is 100% write-off, new or used property with a class life less than 20 years. This includes most farm buildings except for tenant houses that would be on the property. Bonus is automatic unless you elect out. That one is commonly misunderstood. You automatically get bonus unless you tell it not to. And you can't elect out of bonus on a late filed return. It has to be a timely return. You can't take bonus on a leasehold improvement, but you can get 179 on those. And the most important item to note is bonus is going to be phased out. So we get 100% bonus through 2022, then it's 80% in 2023, 60 in 2024, 40 in 25, and 20% for 2026, and then no more bonus after that. Section 179 is allowed on any amount up to $1,020,000 for 19, as long as they don't have purchases, total asset purchases over 2.5 million. 179 is allowed for the first year write-off of purchases, so you can't elect 179 or take any 179 on the second year of an asset. It has to be in the first year. And like we said, for farm and ranch, that includes things like machinery, breeding livestock, fences, bins, calving sheds, all of those good things. All right, let's talk QBI. Now, this was the hot button issue last year when it was new. I think people are kind of calming down about it now. It was more of a non-issue than we thought, but it seemed like a pretty complicated calculation up front. Again, QBI, just for those who aren't familiar, QBI is a deduction on your individual return for qualified business income from a qualified trader business operated directly or through a pass-through entity. So it's 20% of a deduction on your eligible income, and most business income is eligible. Things like guaranteed payments are not included in that, but most income is. Now, specified service trader business income is only taxable if you are under those filing thresholds of $160,700 for single or $621,400 for married. So a specified service trader business, you get the 20% up to that, and then you get nothing after that. If you're not a specified service trader business, then you step into another calculation once you get over those levels, which is the 50% of wages or the 2.5% of business assets. A lot of rental activities can qualify for QBI, but not if it's a triple net lease. So that is the thing that trips some people up there. Capital gains and losses, certain dividends and interest income are also excluded from QBI. Now this little slide here has last year's numbers in there. If you look in those blue boxes, those are last year's limits, but I thought this was a really good graphic for those that don't do QBI all the time to help see how to walk through the deduction. So again, those limits are 160,700 for single or 321,400 for married. So fill those in your mind when you're looking at this chart. But this helps you walk through whether or not you'd get a deduction for QBI. And just for reference, the specified service trade or business, or SSTB, those are things like doctors, anyone in the medical profession, veterinarians, dentists, accountants, lawyers, of course, financial advisors or brokerage consulting, people who are in the athletic industry, or basically if your principal trade or business is your skill and reputation. So those are people that would fall into the SSTB category. If you are not an SSTB, but you are over those limits, the 160 or the 321, it's really important to watch your wages. We've done calculations for many clients to try and make sure, so we're talking about that 50% of W-2 or the 25% of wages plus the 2.5% of qualified property to make sure that we're maximizing that QBI deduction. There's a lot of planning strategies involved with that too, but that's only for non-SSTBs. Any questions on 2019 tax changes? No, there's a lot less going on in 2019, so not quite as many changes there.
Okay, I am not seeing any questions at this time in the queue.
All right. Well, again, if you have questions later or think of things, our contact information is listed on the slides for each one. Contact Lori for trust and estate, or Elise for entity questions, Kim for the IRS resolutions, or myself for anything related to the 2019 tax changes.
Okay, well, thank you. I want to thank our presenters today. I'd like to thank Jenny, Lori, Elise, and Kimberly for presenting on the current state of tax laws in our country. I'd like to thank everybody who attended today's webinar. If you have any other questions, as Jenny said, you can contact any of them, or if you pass those along to the State Bar or the CLE committee, we will pass those along as well. Once you leave today's webinar, you will receive a survey on the presentation, and we would appreciate it if you would take the opportunity to complete that and provide your feedback. You will also receive a follow-up email within 24 to 48 hours with a link to the recording of today's webinar, as well as the updated handout. So again, on behalf of the South Dakota Continuing Legal Education Committee and our presenters today, I'd like to thank you all for joining us, and have a great rest of your day.